Welcome back to the deep dive. We are wading into some pretty deep waters today. And I'll be honest, when I first saw the topic in our research stack, I hesitated a little.
I can imagine.
We're talking about SAP, specifically the order to cash process. And my first thought was, okay, is this going to be dry? Is this just a list of transaction codes?
It does have that reputation, doesn't it? People think of SAP SD sales and distribution as just, a software form where you type in an order.
Right. But then I started reading our source material, and it completely flipped the script on me.
It's not really about the software.
Yeah.
If you dig into what the process is, it's really the heartbeat of a business.
That's the exact vibe I got. The sources frame this as the revenue generation engine. And there was this fantastic quote in there. It said something like, when a CEO screams that sales isn't working.
They usually don't mean the sales reps.
Exactly. They don't mean the reps aren't making phone calls. They mean the machinery is broken.
That's it. They mean a truck didn't leave the dock or an invoice didn't get sent.
Or the money just didn't hit the bank. It's the plumbing behind the handshake.
That's the perfect way to put it. The signature on the contract, that's just the starter pistol. Order to cash is everything that happens after that. And if that machinery jams, if logistics disconnects from finance,
You've got real problems.
you have trucks idling, you have inventory just vanishing, and you have revenue you legally cannot recognize.
So our mission for this deep dive is pretty clear. We want to move from what the sources call the junior consultant view,
Which is just knowing the buttons to click.
the senior consultant perspective. And what is that exactly?
The senior perspective is visualizing the entire life cycle of a dollar. It's moving from how do I create an order to how do I design a revenue engine that actually protects the company from risk.
I liked the structure the sources laid out for this, the golden path.
A four-step flow.
Right. You have intent, then movement, then the legal claim, and finally the realization.
Or in SAP terms, sales document, delivery, billing, and finance.
Let's start right at the beginning. Step one, the intent. The sales document. The notes call the sales document type the constitution of the process. That feels a little heavy for a drop-down menu. Why is it so critical?
It's appropriate, though, because it sets the rules of engagement for the whole game. Think of the sales document type as a switchboard. It tells the system, okay, for this specific kind of sale, here's how we're going to behave.
Well, why do you need a switchboard? Why not just have one standard order for everything? I mean, a sale is a sale, right?
You'd think so, but let's just play that out for a second. Imagine you're a company that sells laptops. When you sell a laptop, you need the system to check the warehouse, reserve that inventory.
Sure, so you don't sell it twice. That makes sense.
Okay, now imagine that same company also sells a consulting service to help set up those laptops. If you use the exact same order type, the system is going to try to check the warehouse for a consultant.
Right, it would freak out.
They would try to reserve stock that just doesn't exist.
Hmm.
Or, take it a step further, what about a consignment sale?
That's where you ship the goods to the customer, but you still own them until they're actually used.
Exactly. If you ran that through a standard order, you'd trigger an invoice immediately. You'd be billing the customer for stuff they haven't even decided to buy yet. So the sales document type tells the system, hey, ship the goods, but do not send an invoice.
Okay, that makes sense. The sources dove into some specific types, and I want to pick apart the differences. They mentioned inquiry versus quotation. A lot of companies I've seen just skip the inquiry part.
They do. And it's usually to save, a few seconds on data entry. An inquiry is just a request for information. It's not binding. It doesn't reserve stock.
So if it's not binding, why would a senior consultant argue you should use it?
Analytics. It's all about the data you don't see. If you skip the inquiry, you create a data gap. You lose the ability to track lost demand.
What do you mean by that?
You know what you sold, and you know what you quoted, but you don't know what customers asked for that you never ended up quoting.
So if 50 people call asking for a specific red laptop, and you just say, we don't have that, and hang up.
Your supply chain team never knows there's a market for red laptops. The inquiry captures what you could call the dark matter of customer demand.
That's a great way to put it. Okay, so then let's move to the quotation. This is where it gets real.
This is where it gets legally binding. A quote freezes the price for a certain period, and the notes highlight a huge risk here called revenue leakage.
Leakage is never a good word. How does a document type stop it?
Okay, so imagine you send a quote to a customer in December. The price is $100. On January 1st, your company updates its global price list. The new price is $110.
Right.
If your system isn't configured to check the validity dates on that old quote, The customer could come back in February and say, I accept. And the system might just pull in that old $100 price.
And you'd be stuck honoring it.
You'd be stuck. A properly configured document type prevents that. It protects your margin.
The sources also flagged returns as a high-risk area. They mentioned a setting called reference mandatory. This sounded like a fraud prevention tool.
It's maybe the single most important control in the whole returns process. Without it, a user could create a return order for anything.
Anything.
I could go into the system, type in that Company X returned 50 laptops, and the system would just trigger a credit memo. You would send cash back to Company X.
Even if Company X never bought those laptops from you in the first place.
Exactly. If you don't require a reference, the system just takes your word for it. Reference mandatory forces the system to ask, which original sales order is this return linked to?
It links it back to the original crime scene.
Well, hopefully not a crime scene. But yes, it links it to the original sale. You can't return something that was never sold, and you can't refund more money than the customer originally paid.
Okay, there was one more document type that frankly terrified me a little bit. The rush order.
Ah, yes. The fat finger risk.
The notes say that with a rush order, the delivery is created automatically right when you hit save.
Speed is the whole point. The customer's on the phone. They need it out the door now. So you hit save, and the system just bypasses the usual review blocks and sends it straight to the warehouse printer.
What if I make a typo? What if I meant to order 10 units, and my finger slips and I type 1,000?
In a standard order, you'd have time to catch that. In a rush order, the forklift drivers are already pulling 1,000 units off the shelf before you've even realized your mistake.
Wow, that is high stakes. So, okay, the Constitution sets these big rules, but the sources say that's not enough. We need surgical precision, which brings us to item categories.
This is a concept that trips up a lot of beginners. If the document type controls the whole order, the header, the item category, controls the individual lines inside that order.
Because an order isn't always just one kind of thing.
Exactly right. You might have a single order with a physical laptop, a service warranty for that laptop, and maybe a free mouse pad you're throwing in.
And you can't treat those three things the same way.
You can't. The laptop needs to be picked. The warranty. Well, you can't put a warranty in a box. And the mouse pad might be free, so you shouldn't charge for it, but you still need to ship it.
So the item category is like the DNA for each specific line item.
That's a perfect analogy. For the laptop, the DNA says check inventory, schedule delivery, bill on shipment. For the warranty, it says no delivery, bill immediately. For the mouse pad, ship it, but price is 0.
And the user doesn't usually type these codes in, right? The system figures it out.
It's a matrix, basically. The system looks at the document type, then it looks at the material master. Is this a service or a product?
Right.
And based on that combination, it assigns the category automatically.
Now, there were some danger zones highlighted here. Mistakes in configuration that can really, really mess things up. The big one was billing relevance.
This is the classic disconnect. You have two main flavors, delivery-related billing and order-related billing.
Okay, break those down for me.
Delivery-related means do not send an invoice until the truck leaves the dock. This is for physical products. Order-related means send the invoice as soon as the order is signed. This is for services.
Seems simple enough, so where's the danger?
The danger is crossing the streams. If you accidentally set a physical product to order-related billing, you might invoice the customer on Monday, but the truck doesn't leave until Friday.
Or worse, the truck never leaves because you're out of stock.
Exactly. And now you have a customer who paid for goods they haven't received. That's a nightmare. But the reverse is even worse, financially.
What happens if you set a service to delivery-related billing?
You will never get paid.
Never.
Never, because you can't ship a consulting hour. There's no physical shipping event. So the system just sits there, waiting for a delivery that is physically impossible. The invoice trigger is never pulled. It's revenue limbo.
That is a subtle switch that could cost millions. The other switch mentioned was schedule line allowed.
That's the go-no-go switch for the supply chain. If that box isn't checked, the line item is basically just a text note. It triggers no demand, no purchasing, nothing.
So if you create a new item category for a product, but you forget to check that box,
The warehouse will never know that order even exists. Sales thinks they sold it. Operations has no clue.
there were some specific examples of item categories I thought were fascinating. TAS third-party deals.
The dropship. This is huge in e-commerce. You sell something, but you don't actually have it in your warehouse. You want your vendor to ship it directly to the customer.
So the item category here has to tell the system not to look in your own warehouse.
Correct. A standard item category would look at your empty shelf and say out of stock. The TAS category tells the system, don't check our stock. Instead, automatically generate a purchase order for the vendor and pass them the customer's address.
And all that complex logic is hidden in one little code on one line item.
Precisely.
All right. So we've captured the intent, we've defined the behavior. Now we get to the physical world. Execution. The delivery.
And this is the shift from a commercial promise to a logistical fact. A sales order is just a promise. A delivery is the realization of it. And the stakes are so much higher here.
Because we're talking about real trucks, real space.
Exactly. If a sales order has an error, you fix it on the screen. It costs you 10 seconds. If a delivery has an error, a truck is sitting at a dock racking up demurrage charges.
Yeah.
That's real money, bleeding out by the hour.
The notes mentioned a few delivery types. I wanted to ask about the stock transport order, the NL type.
This is critical for any large enterprise. You aren't selling to a customer. You're just moving your own goods from, say, your New York plant to your Chicago plant.
Moving money from the left pocket to the right pocket.
In a way, the system treats the New York plant as a vendor and the Chicago plant as a customer. It's an internal sale. You need this specific delivery type because you aren't going to send an invoice to yourself, are you? The NL type makes sure the truck moves, but the billing logic is suppressed.
And deliveries have their own item categories, too.
They do, but they control different things. The big one here is picking relevance.
Which means what?
Does a human being need to go to a specific bin? If you're shipping a laptop, picking relevance is yes. The system generates an order for a forklift driver. If you're shipping a service, picking relevance is no.
What happens if the picker goes to the bin and it's empty?
That depends on the check quantity zero setting.
Check quantity zero.
It basically asks the system, are we allowed to ship a delivery with 0 items? In some cases, you want the system to error out, stop the truck. In others, maybe you want to ship what you have and put the rest on back order. You have to define that logic.
And then we get to what the source material called the point of no return, the PGI.
Post-goods issue. If you remember nothing else from today, remember PGI. It is the single most important button in the entire logistics chain.
Why? What actually happens when you click it?
2 massive things happen at the same time. First, the inventory quantity is deducted from your stock. It's gone. Second, and this is the crucial finance part, the system posts the cost of goods sold, or COGS.
So that's the literal moment the asset leaves the company's books.
Correct. Until PGI happens, that stock is technically still yours, even if it's on the truck. The moment PGI happens, ownership transfers. That asset becomes an expense. If you forget to do PGI, your inventory counts are wrong, and your financial statements are overstating your assets.
It's the click that changes the balance sheet, which leads us perfectly into the final phase. The truth.
Billing. Billing is the audit trail. In SAP, the billing module is the bridge between sales and finance.
And if that bridge is broken?
Then sales is high-fiving about a great quarter, and finance is staring at an empty bank account.
So we have this standard invoice, the credit memo, but I want to focus on something in the notes called a trap, the pro forma invoice.
It's a very dangerous trap, because it's an illusion. A pro forma invoice looks exactly like a real invoice. It prints out, it has a total. Companies use it for customs declarations to show the value of goods crossing a border.
Okay, so what's the problem?
The problem is that a pro forma creates no accounting document. It does not hit your general ledger. It's a dummy invoice.
Oh, I can see where this is going. If a sloppy process lets a pro forma get sent to a customer.
And the customer pays it.
Yeah.
Now you have cash hitting your bank, but there's no accounts receivable entry for it to match against.
The system doesn't even know you were owed that money.
Exactly. Or worse, a sales manager sees the document and thinks, great, we billed them. But from a financial perspective, that revenue was never recognized. It's ghost revenue.
That sounds like an absolute reconciliation nightmare.
It is. You're chasing money that doesn't exist on the books.
Speaking of nightmares, let's talk about fixing mistakes. The notes had a really stern warning about cancellations versus manual reversals.
This is a classic battleground. Let's say an invoice is wrong. The tax was calculated incorrectly. A finance person might just go into the general ledger and manually reverse the entry. Debit this, credit that.
And theoretically, that fixes the books, right? The numbers balance.
The numbers balance, yes. But you've just broken the golden thread.
The golden thread.
The link between the document and the dollars. If you fix it manually in finance, the sales system has no idea you did that. The sales system still thinks that original invoice is valid and open.
So your sales report says one thing, your financial report says another?
And auditors hate that.
So what's the senior consultant way to handle it?
You use an SD cancellation. You trigger the reversal from the sales side. This reverses the financial posting, and it updates the sales history, reopening the delivery so you can fix the data and bill it again properly.
It keeps everything in sync.
You always want the logistical event to drive the financial event, not the other way around.
The last piece of the billing puzzle was account determination. How does the system know which pot of money to put the sale into?
It's not magic. It's a set of rules. You configure the system to ask questions like, is the customer domestic or foreign? Or is the material a product or a service?
And why does that matter so much?
Taxes.
Yeah.
If you sell to a customer in the same country, you probably owe VAT or sales tax. If you sell abroad, it might be tax exempt. If your account determination logic is wrong and you classify an export sale as domestic revenue, you might end up paying taxes you don't even owe.
Or not paying taxes you do owe, which is probably worse.
Much, much worse. That leads to audits and penalties.
So bringing this all together, we've walked the golden path. Intent, movement, claim, realization.
And hopefully we've shifted the mental model a bit. A junior consultant knows transaction codes. They know VA01, VL01N. But a senior consultant sees the flow of risk and value.
Right. They understand the sales order is what should happen, the delivery is what is happening, and billing is the financial truth of what happened.
That's the perfect summary. And the senior consultant knows that the real expertise isn't in that happy path. It's in the exceptions.
What do you mean by that?
Well, think about it. The standard order-to-cash flow order, ship, bill, that's being automated away. Bots can do that. The value of a human expert today is in designing for those complex variants we talked about. The consignments, the third-party dropships, the intercompany transfers.
Because those are the edge cases where things break down.
Exactly. If you only know how to handle the standard order, you really only know 50% of the job. But if you can architect a system that handles all the exceptions without breaking that financial chain, that's where the real value is.
So I guess the question to leave the listener with is, are you designing your system for the 80% of standard orders that run themselves? Or are you building a robust engine for the 20% of exceptions that cause all the financial headaches?
That's the difference between just keeping the lights on and actually driving the business forward.
Fascinating stuff. I will never look at a save button the same way again. Thanks for breaking this all down.
My pleasure. It's always fun to look under the hood.
And thank you for listening to The Deep Dive. We'll catch you on the next one.